Welcome to the Deep Dive. Today we are jumping straight into Innovative Aerosystems. Their Q4 and full year 2025 results just dropped on December 18th. And the market reaction was something else.
It really was. We're here to figure out exactly why that happened.
Exactly. I mean, the stock didn't just move up, it made a statement. A huge one. It closed up over 30% on the day.
And a reaction like that tells you this wasn't just about the numbers. It was, a validation.
The validation of what, though?
Of a multi-year strategy that's finally hitting the bottom line. So for anyone listening, this is your shortcut to understanding that exact inflection point.
Okay, so let's start with the numbers that caused that jump. What was the headline beat?
Well, it was a decisive beat across the board. The market was clearly just waiting for this.
Right.
So let's start with revenue. For Q4, it was $22.2 million.
And the consensus was what, around 18?
$18.11 million. So this just completely blew past it. That's 44.6% year-over-year growth.
Wow. Okay, top line is impressive, but for a company that's all about scaling up, I want to hear about profitability.
And that's where the story gets even better.
Yeah?
Absolutely. The GAAP earnings per share, the EPS, came in at 39 cents, diluted.
39 cents. The consensus was 9.
A staggering beat, a 30-cent beat. And even if you look at the non-GAAP number, which smooths things out, it was 34 cents versus a 12-cent expectation. I mean, this was just a massive operational home run for the quarter.
Okay, so what other efficiency metrics jumped out at you?
Well, the gross margin hit an eye-watering 63.2%.
63%.
63. Adjusted EBITDA, $9.6 million. That's up over 71% year over year. But the one I really look at, for the quality of earnings is free cash flow.
Right, turning revenue into actual cash.
Exactly. It hit $2.0 million for the quarter. That's a 555% increase from last year. They are printing cash now.
And if we zoom out to the full year,
yeah,
it shows this wasn't just a fluke quarter, right?
Not at all. Full year 2025 revenue hit $84.3 million, up nearly 80%. Adjusted EBITDA was $24.8 million, also up over 80%. Management was very clear. This is strong execution, a good sales mix, and finally getting that operating leverage they've been talking about for years.
So that really sets the stage for what comes next. They've proven the model. Now they have to show they built the factory to sustain it.
Precisely. And that's what most of the call was actually about, the permanent infrastructure.
Okay, let's unpack that. That 63.2% margin in Q4 is incredible. But my first question is it sustainable?
Good question. And no, it's not. Management was very transparent about this, which I think the market appreciated.
So what was the one-time factor?
They pointed to a non-recurring benefit of about $1.5 to $2 million. It came from cleaning up some old revenue recognition issues from the Honeywell product lines they acquired.
So some accounting cleanup gave them a nice one-time boost.
Exactly. They stress that going forward, they expect gross margins to normalize. Think more in the mid-40% range.
Which sounds like a big drop, but you're saying it's not actually a bad thing.
It's not a sign of problems, no. It's because their military work, especially on the F-16 platform, is growing. That work has lower gross margins than commercial aftermarket stuff, but it's very sticky and has great incremental EBITDA margins. So it's a mixed shift. That context is vital.
Okay, that makes sense. So the margin story is about normalization. What about the bigger narrative? That the company is now fully built out and ready for scale.
Yes, that's the real story here. They detailed 3 huge capital investments that are now done, complete. First, the Exton facility expansion.
This is the one that tripled their capacity.
It tripled their production capacity. It's finished. This de-risks everything. They can deliver on the F-16, and they can go out and bid aggressively on huge multi-year programs without worrying about CapEx. It completely changes their risk profile.
Okay, so you have the physical capacity.
Right.
But what about the systems to run a business that's 3 times bigger?
That was lever number 2, the full integration of the NetSuite ERP system.
The company's central nervous system.
The central nervous system. Management called this absolutely crucial. It means they can make data-driven decisions, manage inventory, and, get that operating leverage. They can handle triple the volume without tripling their back office costs.
And the third lever.
Human capital. They've poured money into their engineering team. It's now a full third of their total headcount.
And that investment is already paying off in the backlog.
It is. Q4 new orders were $27.2 million, a book-to-bill well over 1. The total backlog is strong at $77.4 million. The momentum is there.
And all this momentum is backed by a really clean balance sheet. Net debt to EBITDA is what, under 1?
Yeah, very low at 0.9x. And that low leverage gave them the firepower to go get a much bigger credit facility.
Right, I saw that. It went from 35 million to 100 million.
100 million, with an accordion feature that can take it up to 125. That's not just rainy day money. That is a war chest.
A war chest designated for what? M&A?
Designated for strategic initiatives.
Ooh.
Read M&A. It's the fuel they need to execute their IA Next strategy.
Which is that big, ambitious target they laid out. Remind us of that.
A target of $250 million in revenue and a 25 to 30% adjusted EBITDA margin by fiscal year 2029.
Okay, so a 5-year plan?
Yeah.
And how do they get there?
It's 2 pillars. High single-digit organic growth plus disciplined M&A. And on the organic side, they're industrializing their biggest programs now. They finished the F-16 production integration and recertifications at the new Exton facility. That's done.
And they're already planning the next step to improve those F-16 margins, right?
Exactly. In fiscal 26, they're going to insource the F-16 subassembly, bring that work in-house, cut out a layer of the supply chain, and drive more consistent, higher margins on that platform.
Okay, let's shift to the really exciting part, the stuff that engineering team is working on, the new product roadmaps. The big reveal was the Liberty flight deck.
The LFD, yeah. Unveiled at the NBAA show in October. This is their big shot at the Giants Garmin, Honeywell, Rockwell Collins.
And what's the hook? What's the big differentiator?
It's all about customer-centric design. You see, the competitors, they offer a fixed solution. If an aircraft maker wants to change it, they pay huge non-recurring engineering costs, NRE.
Right, which could be millions.
Billions. LFD flips that on its head. It's designed from the ground up to be easily tailored for almost any platform without those massive NRE charges.
So it's a much more flexible, almost modular system.
You got it. It's a huge value proposition, especially for smaller OEMs or maybe, these new electric or sustainable aircraft companies that have really unique needs.
That flexibility is a great selling point. But we're talking about aerospace. These product cycles are generational. What's the actual revenue timeline here?
It's a very long runway, and investors need to be patient with this one. Aftermarket certifications for LFD are targeted for around 2027.
Okay, 2 years out.
But the real prize, the OEM production ramp getting installed on brand new planes coming off the assembly line, that's closer to 2030, 2031.
2030, wow. So this isn't a next quarter story. This is a bet on the next decade of aviation.
Absolutely. It's not software. This is a thesis measured in airframe lifespans, not quarters. But in the shorter term, they're pushing ahead with the S2 platform.
This is the one aimed at autonomous flight.
Yes. Specifically targeting autonomous features and AI in the cockpit for the business jet market. And they have a hard deadline. They're delivering the new version to Pilatus for the PC-24 jet in June 2026.
Okay, so that's a very near-term proof point on a high-profile modern aircraft.
It's crucial for proving the tech.
So let's bring this all back to the investor. The stock's total return, over 100% in a year. It crushed the S&P 500. It even beat the specialized aerospace and defense ETF. Analysts are upgrading. Freedom Capital has a $20 target. The enthusiasm seems justified.
It does, but...
There's always a but. They pulled forward F-16 revenue. They got that one-time tax credit. So here's the skeptical question. Was the Q4 beat just a one-time sugar rush to set the stock up before a soft 2026?
That is the critical question. And management, to their credit, tackled it head-on with some very necessary near-term caution.
What did they say?
They specifically avoided giving any numeric guidance for the full fiscal year 2026. And they explicitly said to expect more modest organic revenue growth in 26, slower than their long-term target.
And they gave reasons for that slowdown.
2 very specific timing factors. First, that F-16 revenue pulled forward. Some revenue got accelerated into fiscal 25 right before they had to pause for the transition to the new facility. So that revenue just won't be in Q1 26.
So it creates a tough comparison.
A very tough sequential comparison. And second, that one-time tax credit, the $1.8 million employee retention tax credit.
Right.
It was a COVID-era benefit they successfully claimed. That cash is real, but it's not operational, and it won't repeat.
So a tough revenue comp and a tough profit comp right out of the gate in Q1.
Precisely, which is why they guided Q1 26 revenue to be in the $18 to $20 million range, sequentially lower than Q4.
But they expect it to build through the year.
Yes, they were clear on that. They expect revenues will build as F-16 production gets back to a normal rhythm. It's a classic lumpy aerospace story. You have to be patient through the first half of the year.
Okay, that operational nuance is the perfect setup for our final segment. And before we get to that, just a reminder to everyone listening. This is purely an analysis based on public information. It is absolutely not financial advice.
Right. So with that in mind, given the huge market reaction, that new $100 million credit facility and management's clear mandate for M&A, I think we see a pretty actionable thesis here.
Okay, I'm listening. The big risk is that modest organic growth narrative taking hold in fiscal 26. So how do you play that?
The thesis is pretty straightforward. You go long Innovative Aerosystems, but you're not just betting on organic growth. You're betting on their use of that credit facility.
You're betting on an acquisition.
You're betting on an acquisition. Management said they're looking for smaller, cash-generative component lines with good aftermarket potential. So the outrageous but plausible trade idea is to position for a near-term, say, Q2 fiscal 26 announcement of an accretive deal.
Which would do what for the story?
It would immediately shift the narrative. It would take the focus off that soft organic growth signal and give investors a brand new positive catalyst to latch onto.
It proves they can execute the inorganic part of that big $250 million target.
Correct. It sends the stock higher because they instantly add scale. They probably cross that psychological $100 million annual revenue mark, and they prove they can be a disciplined acquirer. The risk is obviously integration failure or no deal happens, but the reward is immediate multiple expansion. They become a proven roll-up platform.
Okay, so to recap the core takeaway here, Innovative Aerosystems is making that transition. They're moving from just a high-growth story to a truly scaled, infrastructure-ready platform.
And that Q4 beat was the decisive proof point. It was validation supported by the new capacity in Exton and the long-term vision of platforms like the LFD.
So let's leave our listener with one final thought to mull over.
Here's the question I keep coming back to. Given that long, multi-year runway for something as game-changing as the Liberty Flight Deck 2027 for aftermarket, maybe 2031 for new aircraft, how much should you, as an investor, be willing to pay for that massive future opportunity today? How do you weigh that against the near-term certainty of just high single-digit organic growth?
That's the classic valuation challenge, delayed disruption versus near-term visibility. Fantastic insight to end on. Thank you for diving deep with us.
My pleasure.
We'll be back soon with more deep dives into the documents.